Welcome, everybody. I hope you are having a fantastic afternoon or morning. And we're going to get started here in just a couple of minutes, waiting for a couple stragglers to hop on in here. Stand by for about 30 seconds to a minute, and we'll get this thing rolling. Just letting some folks in here. Perfect. I hope everyone's having an excellent day so far. And Jen, if I'm sharing, would you mind just letting folks in there? Because I can't seem to share and let people in at the same time. All righty, folks. Give it about 30 more seconds and we'll go ahead and get started here. All right, we're going to get started here to be respectful for everybody's time. Again, thank you. Welcome to all of you who have just joined. My name is Adam Levine. I'm your brokerage director here at Back Nine. And today we have two special guests with us from MassMutual. And I will introduce them in just a second here. If you are new to the platform and have never signed in before, please use the back9signup.com or the associated links. I'll pop those in the chat here in just a second. That way we can make sure to thank our referral partners. If you are already signed into Back Nine and you don't know who your marketing manager is, please to make sure to drop in the chat. I don't know who my marketing manager is, and I will be happy to get you connected. Okay, so today we're going to learn a little bit about whole life. I'm going to go over some basics with you here today, and then I'm going to turn it over to the experts. And today we have one of the most well-known and most recognized companies in the whole insurance industry to begin with, but definitely the name you think of when you think of participating whole life, which is MassMutual. And so we have Ryan and Jennifer. Thank you so much for joining here. Glad to have you. I'm going to turn it over to him just a few minutes. And they have been so kind to sponsor a little bit of merch here. So I'm going to be giving away some polo shirts and some cool stuff throughout the program. So make sure to stay tuned. Okay, so today we're going to learn about the history of whole life and how it evolved, as well as we're going to compare the two main kinds of whole life insurance, which are participating and non-participating policies and what the differences are. And then we're going to go over some of the whole life guarantees, identify a few client profiles, and we'll turn it right over to Ryan and Jen. Okay, so a little bit about whole life. Now, whole life is actually one of the oldest forms of life insurance. Originally, it goes back to the mid 1800s, way back, and it's really designed for lifetime coverage. So we all know what term insurance is, term being for 10, 20, 30 years typically. Well, whole life is what it sounds like. It is for your whole life. We may have many cases where we'll do a juvenile policy and that thing is meant to last until that person's 100+ years old. So they may have this product for 100 years. And after being in the business so long, I've seen clients now that have had their whole life policy for 40, 50, 60 something years. So it is definitely that bedrock of the life insurance industry. One thing that makes whole life unique is a mutual company. And mutual companies really pioneered the participating whole life and allow for dividends. And that's really something to make your policy owners, well, a part owner in the company too, hence the name mutual. right? And it's expanded from just personal use where it was on individuals to now we use whole life as a business planning tool as well. And you can kind of see here from the tree a little bit, right? It's very stable. It's your deep, deep roots. Dividends being the main attractant to your mutual participating whole life policies. Okay, so let's look at the difference between participating and non-participating. So again, dividends really being the main thing. And with participating whole life, boy, oh boy, talk about track history. The dividend participating rates go back 150 plus something years. I mean, even for the past 40 or 50 years, it has well outperformed many other of your traditional investments. Whereas non-participating will not have a dividend. Instead, they will have a declared fixed rate. So when you sign up for these policies and you get a non-participating whole life, you still are getting interest credited to your account. However, it's a fixed declared rate that you get at the beginning and it doesn't change over time. Now, as far as premiums are concerned and a participating whole life, yeah, it's a little bit higher in the beginning to allow for things like for the dividends. But you'll see over time, and I'm sure Ryan and Jen can extrapolate on this, it's well worth it with your paid up additions as well as your dividends and structure. You'll get a lot more out of it. However, if you're looking for cheaper whole life, you definitely want to look at non-participating. The cost of insurance is much less, but again, there's also no dividends. There is a lot of upside potential with the participating whole life with paid up additions. In fact, I use participating whole life quite a bit for LIRP, our life insurance retirement planning sales, because it works the same way as any other cash value policy. We start low and we get that growth, and then we can extract that cash value tax free through the use of loans. In your non-participating policy, however, it is limited to the fixed declared growth, which for some clients, that's great. You can show them it's going to be X amount of dollars based on this timeline, and here's what it is. They are going to get what's stated on the illustration. And as far as carrier types go, again, we're dealing with a mutual company. Usually, there are some stock companies that have a participating line of business, but by and large, you're going to see that out of a mutual company. And then with non-participating, that's where you'll see the stock corporations and unless they have some kind of special line, they are generally going to be your non-participating policies. Hope that makes sense so far. Okay, let's look at the guarantees of whole life. The main benefit behind a whole life is definitely the guarantees. Guaranteed death benefit, guaranteed premiums, guaranteed cash value, right? That is the main point. This product is going to do exactly what you say it's going to do so that 10, 15, 30, 40 years down the road, your clients come back to you. It is exactly what you told them it's going to be, right? We use whole life as lot, like I said, for life insurance retirement planning, but it does have that wealth building potential as well. And one of the things that I like to focus on with some of my clients that I deal with personally, or even some of you that I've interacted with, is make sure you take a look at those pay designs. Okay, you can pay for lifetime, but there's a lot of value in paying in over 8 years, or 10, or 15, or 20, or till 65. Paying to 65 again, it fills right back into that life insurance retirement planning niche. And then the next part is the cash value. That non-participating policy has declared rates. They're batting about 3 to 4% right now. And while it's participating has a guaranteed minimum, but those dividends have a history of 6 to 8% for at least the past 40 years. So that's been incredible. All right, next. Who are we looking for? Okay, a great prospect for whole life is going to be a high income earner who's looking to place some excess income in the safe money product. Maybe they earn $400,000 a year. They've maxed out their IRAs. They've maxed out their other retirement plans. And so now they're just looking for growth in a safe money product with tax advantages. Bingo, that spells whole life to me all day. Your accumulation cells, right? Somebody does want the accumulation aspect of life insurance. maybe they have a little bit lower of a risk tolerance. They don't want to be exposed to the market in a VUL. They're not sure about the index thing. Hey, accumulation sales all day long for whole life. Like I said, that's where I like to use it for life insurance retirement planning, as well as high early cash value, which I'm sure we'll get into that as well. Um, Life insurance or whole life insurance is also a great hedge against the stock market itself. Because remember, these are non correlated assets. Your dividends in whole life are not based off the market or an index, it's based off the insurance company's general account. And let me tell you, insurance companies are great at making money. And so they'll take that general account and do what they do with it. And your dividends are based off of their take. Another great use for whole life is legacy planners, those who are planning on multiple generations receiving an inheritance and income. Generation skip plans. That's all advanced planning. We'll get into that stuff later. And then when it comes to commercial life insurance, as we discussed last week, business owners love it for buy-sell arrangements because they don't know how long their agreement's going to be, hopefully a lifetime. So we don't want to put them in a term product that'll expire in 10, 20 years. We want them in a permanent product that's going to last their lifetime. As well as executive bonus plans. Maybe you got that key person, you got that sales rep, you got that manager who they want to attach the golden handcuffs to and keep them in the business. A great way to do that may be whole life. And then, of course, estate planning purposes. Those who have large enough net worths where they need an ILET. An ILET is a life insurance trust. So that, again, something we'll go over in the advanced planning parts. Prepaying estate taxes. Certainly there's those with very high net worths that are exposed to the federal estate taxes, but people forget about 9 states have estate planning taxes as well. And so one angle you can take is to prepay those estate taxes using a life insurance policy. And of course, final expenses. Okay, and then we have another type of whole life. I'm not going to go into this too much, but I figured I'd touch on it, which is final expense whole life. And although it is whole life, it has the same basic idea that it's permanent, it will never expire, it'll last a lifetime. It's not quite the same as fully underwritten products. Final expense has a very high cost of insurance because they are taking significantly more risk. So do not look to final expense life insurance as a growth product. These typically will have smaller death benefits, 5,000 to kind of 50,000, designed to cover the funeral, the burial cost expenses only. You will find those in a simplified issue or guaranteed issue. What that means is, again, very high risk, very little underwriting, and in some cases, those death benefits may not be available to that person right away. They may have to go through a 2-year ROP period, meaning if they pass in the first 2 years, the family will get their money back. Okay, it's a return of premium, but the full death benefit will not be available into 2 years. And these products are typically targeted towards low-income seniors. Right, and so I know that was a quick little download. I hope it wasn't too much for you, but I want to give you some context as we lead into our next segment here with Ryan and Jennifer. But first, I'm going to ask our first question to see if everyone's paying attention today. Okay, so what is the biggest difference? And you can just drop this into the chat when you're ready. What is the biggest difference between whole life and participating whole life? Non-participating and participating whole life. Ooh, Damon, quick on the gun. Yes, Damon, that's 100% correct. It is the dividends. Excellent, excellent. Damon got to it first. So Damon, shoot me an email when you get a chance here with your size and your shipping address. And MassMutual will be glad to supply you with a nice polo. And yeah, thank you for answering. Stay tuned for more. We're going to have more of these. All right, well, without further ado, I'll take a step back. Ryan, Jen, so nice to have you. You guys are some of the best people in the industry, so thank you so much for joining us. And without further ado, I guess then, Ryan, Jen, all yours.
Hey, appreciate it, Adam. Thank you. Great intro there, too. I love it, and I think we might echo some of the things that you said, but this is our first time being on your meeting here. So again, appreciate the invite. Just by way of introduction, I know Adam mentioned our names. Ryan Strick out here from the West Coast, been in the industry since 2000. Been here at MassMutual Strategic Distribution for about 2 years. Prior to that was with AIG for around 17 years. Spent some time at MetLife, and even before that, AXA Equitable. I am the managing director for the West Coast, and my partner is Jen. Jen, you want to quickly introduce yourself?
Yeah, thanks, Ryan. And Adam, thanks for letting us join your call today. We really appreciate the time. We're excited to be here. So my name is Jen Therian. I am an internal for Ryan on the West Coast, but I actually go to the home office in Springfield, Mass. So I live in Connecticut. I have 2 little boys. And I have been in the industry for probably about 10 years now. MassMutual, I just celebrated my 1 year, but spent the majority of my life career over at Lincoln prior to moving over here. So really excited to be here and excited to talk to you guys about whole life today.
Absolutely. So we got you covered, West Coast and the East Coast. So as far as our agenda today, we want to quickly kind of touch on who is MassMutual Strategic Distributions, or MMSD as we're typically called. We will touch on our product portfolio, and then we'll kind of spend the bulk of the time on kind of why whole life, and kind of echo some of the things that Adam mentioned earlier. But just kind of starting off with MMSD, we launched in 2021, and that people might kind of raise their eyes and say, I thought you guys have been around a long time. So MassMutual has been around a long time. MMSD has been around since 2021, and we are a subsidiary of that is launched into the brokerage space. And the reason I want to bring this up, because there might be some on the call that are like, hey, I'm appointed with MassMutual. There is a MMFA side, which is the career side. And then there's MMSD, which Jen and I represent, which we just mentioned started in 2021. That is in the brokerage spot. So I bring that up because if you are someone that is maybe already appointed with MassMutual, you might want to reach out to Adam or Back Nine and make sure you find out exactly who you're appointed with. And there might be some benefits if you're not appointed with MMSD to get appointed. So again, I'd reach out to Adam and ask. You can be dual appointed. But again, there might be some benefits in being appointed with MMSD, so I encourage you to do so. And at the end of the day, I think it comes down to, as Adam said earlier, we are one of the biggest companies in the industry, especially as it relates to whole life. And an important part of any carrier out there is their financial strength. And obviously, you can see our report card is one of the strongest in the industry and something that we're very proud of. As it relates to our product portfolio, we're not just whole life. Again, we're kind of known for being that whole life company, and there's nothing wrong with that. There's a lot of our eggs are in that basket. But just for what it's worth, we do have both term products. We have a very VUL products. We have guaranteed universal life products, and then we have the LTC hybrid products. What we do not have is index universal life, a popular product in our industry. But again, we are known mainly for whole life, and we will we'll focus on that product today. As it relates to the portfolio, there is a whole bunch of different products as it relates to whole life in which you can choose from. There's more that are driven towards the accumulation. There's more towards the protection. And Jen, I'll just kind of pause real quick if you just want to touch on this slide.
Yeah, absolutely. So like Adam had mentioned before, with whole life, you are going to get an interest rate. So right here, every single one of our products is going to have a different interest rate associated with it. And these are the guaranteed interest rates for all of our products. So as you can see over here, you see our whole life 8, and then all the way over here, you see our whole life 100. I can tell you with the shorter pay, you're going to have more accumulation. So with that whole life 8, that's going to be the max accumulation. And then going all the way to the whole life 100 and the whole life 65, those are more geared towards protection based, that death benefit sale. So I know a lot of you are IUL people. I believe that's why Adam asked us to come on. So any IULs that you guys have, we can try and replicate that with our 8 and 10 pays if we're looking to overfund. So our whole life 8 and 10s are really designed for lowest DB max cash accumulation, and that we can design for you. Say you have, hey, Jen, I don't want to pay all 10 years. I want to pay 5 years. We can do that. What we will do is we will take I don't want to get into too much and confuse you guys, but we'll use the cash value in the policy to pay the additional 5 years in the contract. So if the client just wants to pay 5 years, we will use cash value in the policy to pay those remaining 5 years of the contract. I kind of stopped there.
Yeah, no, that's perfect, Jen. And I
Yeah.
appreciate you bringing that up. So kind of like what Adam said earlier, he uses some whole life for those alert type sales. As Jen kind of mentioned, you're going to look more at that 8-pay, probably that 10-pay that's going to generate more cash accumulation. And then Adam also mentioned juvenile policies, which we tend to see more on that whole life 100. But I like the point that you brought up, Jen, about kind of the being flexible, if you will. Because again, from a guy that spent so much time in the field selling IUL, I've come over here the last 2 years drinking in the Kool-Aid on whole life, and I'm a strong believer it is one of the strongest products out there. And so some of the kicks in the shin I'll get is, well, it's not that flexible. So just note that 10-pay product is a 10-pay contract, but exactly what Jen said, if you just want to pay 4 years, you can still do that. There is some flexibility in that. And then the policy will pay the remaining X amount of years to fulfill that contract through its cash accumulation and the paid up additions that will get to the dividends, et cetera. So again, appreciate you bringing up that point. And so let's kind of circle into why whole life. And I want to try to keep this kind of simple. And this is kind of what I've coming from an IUL world and coming over here, kind of looking at the big picture and why whole life for both, not just you, the agents, but for your clients as well. So when we look at why for the clients, and I'll echo some of the things that Adam mentioned, it comes down to guarantees, guaranteed premium, guaranteed cash value, and guaranteed death benefit. Again, for something as important as a life insurance policy, I argue that guarantees are certainly important, and we don't have just one, but we have 3 of them. Also, the cash accumulation that is growing in these policies is tax deferred, and then you have the potential, pulled out correctly, to pull it out tax free. And then it's the guaranteed cash, it's not tied to the market. And I think that's an important part, is that it's a non-correlated asset. So again, it's not tied to the market. I kind of like to say, if the market goes up, whole life goes up. If the market goes down, whole life goes up. So it's kind of that tried and true that Adam mentioned is going to last the long haul. And then added flexibility through riders. And this is an interesting one, because as I come over here, I've kind of, again, I use the term kicked in the shins that, oh, Ryan, whole life's expensive. I'll say expensive compared to what? Well, compared to an IUL, in which case I'll say it's not an IUL. It's a different product. But that said, if you're talking to your client, and maybe IULs may be a little more expensive depending on the scenario, but they like the fact that there's guarantees, price versus value, they're willing to pay maybe a little bit more. Just know that there is some riders that we can add onto our policies, mainly a term blend that can help maybe put that price into a little more affordability for that particular client. Now, we're not going to get too deep into the riders today, but I'll also say that's where I get, again, kicked in the shins that, oh man, whole life, it's just complicated. And I'll say, what's complicated? You got guaranteed premium, guaranteed cash, guaranteed death benefit. Well, you got those riders, you got the, what are they called? Listers, ailers, and a couple riders. Lister is literally just a term blend. And quite frankly, I wish our company just called it a term blend rider. But we have these fancy names to them that start to get complicated. So don't let a few riders complicate the big picture, which is, again, guaranteed premium, guaranteed cash value, guaranteed death benefit. And I joke with my friends, listen, if you want to get in kind of the weeds and you can really explain back to me how an index universal life works with how the company creates their caps, their participation rates, the bonus multipliers, the proprietary indexes, if you can really understand that, I can promise you can get your hands around a couple riders. So again, don't make the product too complicated. At the end of the day, guaranteed premium, guaranteed cash value, guaranteed death benefit. And then, kind of like Adam mentioned, you have that potential to receive dividends. And those are not guaranteed, but there's never been a year since going back to 1869 that we have not paid out a dividend. And we tend to have some of the strongest, if not the strongest, in the industry. We're showing you 20 years here for some of my competitive friends. Certainly, if you want to go back farther, we have marketing pieces that can show you that. But dividends are a great value add. As Adam mentioned, we're a mutual company. So the policy owners are owners of this company. And as we have good years, it comes back in the forms of dividends. And again, a great value adds that life insurance policy. And you can use it as Adam mentioned, as a paid up addition that goes right, the dividends go right back into the policy and help increase that cash accumulation. You might want to use it in a particular year to help pay the premium or help pay off a loan. You might want to take cash in hand. So you have that flexibility, but having those dividends is certainly a great value add and a big part of our whole life product and having that participation. So again, and we can certainly share any of the pieces that we show up in this presentation today. We can send them to Adam, and if you're interested in getting more of them or what you're seeing, reach out to him and he can share that with you. But again, from MassMutual standpoint, we tend to have one of the strongest, if not the strongest, dividend in the industry. Now, when it comes down to the agent on why, I think you can help meet and exceed clients' expectations. I think we're all in the business, or I think we'd like to hope to be, that we under-promise and over-deliver. We want to give higher probability and lower volatility for our clients. And I think that whole life is tailor-made to do just that. Again, nothing against Index Universal Life. I am a fan of Index Universal Life. I own Index Universal Life. But we've seen some highs and lows, a lot of cap rates changing and participation rates changing and companies change, et cetera. It's got some volatility in there. And sorry, things are popping up on my screen here. But again, I think this is a product, and this is just kind of me talking, that this isn't necessarily one that you're going to maybe have to be apologizing for 10 years down the road because it's changed and it doesn't look necessarily like the illustration that it was sold off of 10 years ago. Again, because of potential cap rate changes, participation rate changes, industry changing. Again, non-correlated asset. Market goes up, whole life goes up. Market goes down, whole life goes up. And then you get those guarantees. Again, as I just mentioned, not tied to the market. So I kind of call that sleep insurance. Sleep insurance for the client. We can kind of look at whole life almost as an extended term, so to speak, but it's from the aspect of kind of sleeping well, knowing that no matter what's going on out there, assuming I pay my premiums, my policy is going to do well. And that's also going to be sleep insurance for the agent as well. Now, this is kind of an older slide, so I apologize. But it's, you can see that bullet there. Whole life is 34% of the insurance market. Depending on going back to LIMRA, depending on the year, typically 34 to 38%, being the number one selling product in our industry by way of premium. And whether it's 34 or 38, I would argue that is a pretty big number. In which case, I always argue to my agents, if you're not looking at it, if you're not selling it, there's an agent down the street that is. So at minimum, just get it on your radar if it's not already. Just kind of have it in your mix. If you sell IUL or you sell VUL, as Jen mentioned earlier, great. There's nothing wrong with that. Maybe you're looking at an IUL policy, but you also show them a whole life policy. And if there's anything that we can do or Back Nine can do to help you run those illustrations, educate you more, don't hesitate to reach out. And then compensation. And I'll mention compensation. I don't think anybody cares about compensation. Wink, wink. But it is part of the sale. It is part of our story, if you will. Because again, using that term, I get kicked in the shins as I come over here and I'm talking to all my IUL friends about looking at whole life. I'll get kicked in the shins on the compensation. But I argue back that it's actually a really good story. And I'll share this slide here. This is an example slide of an IUL versus a whole life. Now listen, you can see right here, $100,000 premium. You can see at the bottom left, the target is just over 32. IUL versus whole life. Whole life with the New York compensation, I'm just going to go base at 55. What you might make on it, that's not my business, but just what we'll pay you out direct, 55 versus an IUL potentially paying you 90 on the target. You can see year one on a whole life versus the IUL. Hey, listen, cards on the table, more times than not, the IULs might beat us out on the commission. I get that, and I accept that. But where the story really kicks in is when I ask my friends who sell IUL, now what are the renewals you're getting on that? In which case I usually get, do I get renewal? I don't, 1% maybe, 2%? I don't know. I have no idea. But when I tell them, hey, on whole life, 10% for the first 5 years and then 5% after, that's when they kind of perk up and go, oh, wow. And you can see just based on this example here, 10 years down the road with those renewals, you can sometimes, depending on what you're making, double what you were making on the IUL. On a product, again, that I'd argue with those guarantees, you got that sleep insurance that, again, you might not be apologizing for 10 years down the road just because various changes in the industry. So again, I think there's a story here. And you'll never hear me to tell you stop doing what you're currently doing and just sell whole life. I don't believe that at all. But I think for those right cases, you get a couple whole life policies on your book every year. Those renewals start to add up every year, and you wake up on January 1st. Now, assuming your clients are paying the premium, you got a nice commission coming in already that you know right at the beginning of the year. So again, not to harp on comp. It's not why we sell our products, I hope, but it is an important part of the overall story. And then I kind of use this analogy. Again, 2 years over here. For the longest time was out there selling other products. 2 years ago, sold whole life. And we can kind of chalk this up as the dumb RVP kind of giving this, but I really believe it's kind of resonated with some of the people that I've talked to in price versus value, because I'll be the first to say that we might not be the cheapest on the spreadsheet. I get that. You heard me earlier. Cheaper than what? Well, people say, well, cheaper than IUL. We're not IUL. We're a different product, but I'm not naive to think that we all kind of go on that same proverbial spreadsheet, right? It's an insurance product. And we might not be the cheapest on the spreadsheet. You heard me earlier. If we're not, we may have some riders that can help. But regardless, again, it comes down to price versus value. Are you asking your clients how important is guaranteed premium, guaranteed death benefit, and guaranteed cash accumulation? It might be. And when I look at price versus value, sometimes if I'm standing in front of a group, and I certainly won't do it on here, but I'll ask people to just kind of hold up their car keys. And I get the eye roll and all right, here it is. And the reality is we all might be driving different cars on this call, right? We all might, some of us probably driving the same, but we all might have different cars. And as I go out on the street today, I can promise you it's not all the same car. But if we put all of our cars on this call on a line, I'm pretty positive we'll all get to the same point A to point B. And a car is what? It's a box with 4 tires, steering wheel, an engine, brake, and a gas pedal. But we're not all buying, the last time I looked, the Toyota Corolla is the cheapest on the spreadsheet. And if you might have driving a Toyota Corolla, great. There's absolutely nothing wrong with that. But we all drive different cars because of why? The value that it has to us. You might have a large family and you're driving a minivan. You might be the surfer down here by me in Southern California. You need the truck bed to throw your surfboards in the back. You might like the luxuries that you get with a Mercedes or a BMW. But we're all not driving the Toyota Corolla. And it comes down to price versus value. So just because we're not necessarily the cheapest on the spreadsheet doesn't mean we're not necessarily one of the best products on the spreadsheet. And are you having that conversation with your clients? Hey, we have this product, but we also have this product, non-correlated asset, and let's talk about the guarantees. And maybe that's worth maybe the extra dollars in having that peace of mind of having guaranteed premium, guaranteed death benefit, guaranteed cash value, and that potential for the dividends. So again, you'd be surprised as simple as that analogy might be, that people remember that, and when they're having those conversations with some of their clients, that it comes up. Price versus value. Now, upside potential, downside protection. That is something for those on the call that might be familiar with, because as I mentioned, prior to coming here, close to 17 years, I was with AIG Corebridge, and a lot of what I was selling was index universal life. In fact, we didn't necessarily even have a whole life product, but that was kind of my story. Upside potential, downside protection, zero is your hero. And where we don't have an index universal life at MassMutual, I still think that verbiage, that story still applies with whole life. The upside potential, where we don't track a particular index, we have that potential for that non-guaranteed policyholder dividend that we talked about earlier, that MassMutual tends to have one of, if not the strongest in the industry. And then you have that downside protection of what we've been talking about. Guarantees, right? And again, not just one, but 3. Guaranteed cash, guaranteed premium, guaranteed death benefit. And so, again, I'm out there telling that story. And a lot of the times I get, let me see if it's, well, Ryan, I like that, index products have market exposure, or my other products that I use have market exposure. Again, I get that. You're not going to hear me say anything bad about any of their product lines out there. But I'll also argue with them that when we're talking, especially with some of the bigger cases and their larger clients, that their clients already have market exposure, whether that's their personal financial portfolio, it's their IRA or 401k, they already have that market exposure. So for something as important as their life insurance policy, which is not car insurance, this is something they are opting to buy, why would we not want to give them something that has guarantees on it? And again, as I mentioned earlier, not just 1, but 3 guarantees. Something as important as a life insurance policy can be for them. And I use this slide, you might have seen this slide with various carriers, is if I was to ask any one of you on this, do you put your clients' money into the taxable bucket? Is it all in the tax deferred bucket? Or is it all in the tax advantage bucket? Most of you are probably going to say no, in which case I'll ask why, and you'll say, because we diversify. And I completely agree with that. And what I'm not seeing a lot of agents doing in our industry is diversifying with their clients' life insurance. And we're starting to see more of a trend over here. And I think in the industry as a whole, we're starting to see more of a trend of creating a life insurance portfolio. So where I think I see a lot of the time, and there's certainly nothing wrong with that, is we'll see a client, we'll realize they need life insurance, and we will find that one product, and then we'll find sometimes the cheapest on the spreadsheet with a reputable carrier, and we'll sell them just that. Again, nothing wrong with that. But what about that concept of creating a life insurance portfolio? So as Adam was talking about earlier, maybe he's selling for cash accumulation, for a LERP type sale, for the retirement years when they're no longer getting a paycheck. I like to call it mailbox money, where they use their life insurance policy to start pulling out money from their life insurance policy during their retirement years. Great, we see that done all the time. And we might get a VUL for that, or we may get an IUL product for that. Great, but I'm just going to make up a number. Let's call it a $100,000 sale. And we get a VUL product, and it's meant for that. And let's fast forward down the road, and that client's retiring, and now they're using their life insurance policy for cash accumulation to help them through their retirement years. And then all of a sudden we have a negative year. We don't have the crystal ball, right? Maybe we have a negative year. Maybe we have two. Well, rather than pause, or rather than keep pulling from that VUL or the IUL, let's pause, let's let it recover, and pivot over to that whole life policy that we put into the life insurance portfolio, that non-correlated asset. Maybe we put 70,000 into that VUL or IUL, and we put 30,000 in that whole life. And while we're going through a downtime in the market, we're letting the other product recover, pivot over to that cornerstone, that whole life policy, non-correlated asset, and we start pulling from that through our retirement years. And then maybe the market recovers and we go back to that VUL or IUL. So again, as I mentioned earlier, if you're not already looking at whole life, I encourage you to do so. And it doesn't need to be all or none. I'm not a whole life or no life type of guy. I think there's room for all of it. I think that life insurance portfolio makes a lot of sense, especially seeing that whole life is that non-correlated asset. If that's something you're interested in, and we will send this over to Adam following the meeting so you guys have access to it. We do have a marketing piece that kind of shows that that concept, that stacking of products. We have both one that shows whole life and IUL, as we show up here. And we also have one that shows IUL and VUL for those of you guys that might do VUL. But the concept makes a lot of sense, and we're more than happy to share some of the successes we've been having with that concept. Again, a life insurance portfolio. Now I'm going to kind of end with a sample case, if you will, a sample scenario. This did not happen in Jen and I's region, but it happened in a friend of mine's region here at MassMutual, and so I kind of brought it over. And it's interesting when I talk about this particular scenario, the sample case, if you will, somehow I bleed myself into it. And I try not to, but somehow I keep coming back to it and putting myself into it because I can relate to this client. Because I own a lot of different insurance policies, but I do have some index universal life policies. And again, as I just mentioned earlier, you'll never hear me say that whole life is better than IUL or whole life is better than VUL. I completely believe that there is room for all different products. We have seen a lot of changes with IULs, and with cap rates changing and participation rate changing, we are seeing a lot of IUL rescues that we're doing right now. And as people get older, they become a little more conservative, and whole life is a great product for that. I look at my own policy that I bought a long time ago. It looks nothing like, unfortunately, the policy that I bought when I was a lot younger. And speaking of complicated, it's cards on the table. It's an AIG policy, and it tracked the Hang Seng, the Euro stock, the S&P. It was a 5-year point-to-point. Talk about a complicated product. It certainly is. But this is, again, I relate very well to this particular client. She's a female, 53 years old. She's a business owner who needs life insurance. And as I go through the sample, I want you to kind of think in your own book of clients that you might have that might be in a similar situation as this gal is, or maybe even myself. Female, 53, business owner who needs life insurance and would like the potential for cash value accumulation that is not tied to the market. She owned an index universal life purchased in 2005 at the age of 35. I bought my policy. I'm over 50 years old now. I bought my policy around the same age. I was in a different mindset back then. I was a little more looking a little more volatility. Certainly retirement wasn't on my mind. Now, as I've gotten older, I'm starting to look down that path of retirement. I'm getting a little more conservative. But again, when I bought my IUL, again, here I am putting myself in that position, very similar to this particular female. She experienced multiple changes in ownership of the IUL carrier, encountered service issues due to the changes. I'm not going to do any hits on AIG, but I will tell you the product that I bought is no longer sold at that company anymore. So when I tried to get information on it, etc., it is a lot more complicated. She was concerned about the decreases in cap rates on the IUL policy and disliked all the moving parts with IUL. We've seen it, right? I can't argue against that. We've seen cap rates change, participation rate changes up and down. And I would argue that, yes, IUL does have a lot of moving parts, right? She wants to work with an industry-leading company with a long history of honoring its commitments. And who do you think that might be? So the cap rate on the IUL policy she had was 6.25 with an illustrated rate of 4.06. She wanted a policy that had guaranteed death benefit. Again, she's now older in age, probably closer to those retirement years. She wants a policy that has those guaranteed death benefit, guaranteed cash value growth, right? We talk about the alert type sale where we might be using that cash accumulation through our retirement years. That's now more important than ever as we have to get older. Potential to supplement income at retirement. And that client would also like a policy that is not tied to the market. She does not necessarily want all the volatility that she had with the Index Universal Life. So the solution is we took the IUL, and we see this a lot. Like I said, we're seeing this a lot. We're calling them IUL rescues, but we took that 1035, lump summed it into a MassMutual 10-pay whole life with an AILR. Okay, that's just another rider that we use to help bring that money in without it mecking. Again, don't want to get too tripped up on riders and making it sound like a complicated product. It's not. But we kept that same face amount. And when we did this, our policy illustrated roughly 50% higher, more distribution based on our 2023 dividend schedule. Okay, so we met exactly what she was looking for. She got that guaranteed death benefit that's associated with the whole life. She got that guaranteed cash value that's associated with our whole life. Potential to supplement the income of retirement because we got that guaranteed cash. And the potential for more with those paid up additions from those dividends that, again, are not guaranteed, but there's never been a year that we have not paid them. And a policy that is not tied to the market. Again, I said it earlier, whole life is a non-correlated asset. And we won the business with the 10-year whole life policy. So I'm going to kind of pause there. But, and I don't want to get ahead of myself here, but Adam, you and I had a conversation the other day, and where we kind of showed earlier our product mix where we lean heavily on whole life. That is not all we have. As I showed, we have term policies. We have a great VUL policy for those of you who might do VUL that we came out recently. But more recently than not, we just launched a guarantee universal life and a survivorship guarantee universal life. That looks very, very strong. Now, say that with a caveat. It looks very, very strong in short pay scenarios. So that 1 pay, that 5 pay, even going up to that 10 pay, we look really, really strong. Outside of 10 pay, it's kind of anybody's game, but we still look really good. The premium looks really good. The target looks really good. Adam, I heard you talking about ROPs earlier. There is a option on this policy that in year 20, for whatever reason, no questions asked, you want to get 50% of your premium out, we'll give it back to you. In year 25, no questions asked, you want to get 100% of your premium, we will give it back to you. It's got a living benefit chronic illness rider added to it, as well as a terminal illness rider to it. So again, a really strong product. Also note, at this point, it's not approved in California, nor is it approved in New York. And what a lot of people are also liking is, you heard us talk about comp earlier. Again, I still think whole life with the New York comp is still a great story. I really believe that when you start looking at the renewals. But just note that both our VUL as well as the GUL and the survivorship GUL that I'm talking about is non-New York compensation. So really, really strong gross compensation. And again, I'm not going to get too into the weeds in it now. We can save that for a different conversation. If you're interested in hearing any more about that particular product, we call it the UL Guard, or any more information on our whole life products, please circle up with Adam. He's very knowledgeable, and he knows certainly how to get a hold of everything that I've talked about today and then some. And with that, Adam, I'll hand it back to you and see if you have any questions or want to give out any more prizes.
No, let's do it. Ryan, that was excellent. Thank you for dropping some gold there. That was really good. I hope everyone was paying attention. because our next question, so get ready, keyboard warriors. Ryan mentioned this. I mentioned this too. There are 3 guarantees in a whole life product. What are those 3 guarantees? There you go, Dina. Ooh, she's quick. She was waiting for that one. Dina, thank you so much. Yes, guaranteed premium, guaranteed cash value, and guaranteed death benefit. And so, Dina, if you'll please email me your shirt size and shipping address, we will get a nice polo right out to you. But right on the spot on there. Good job. Okay, so that brings up Ryan's point. This is a very open format. We want you to learn something and take away something today. So does anybody have any questions? Type them in the chat here, or you can raise your hand and I will unmute you and you can ask. And I feel like we need a little Jeopardy music here, Ryan.
Hey, in all honesty too, not everyone's comfortable jumping on and asking questions. You can always, always email you two after, and you know how to get a hold of us if we need to jump in.
Nope. Okay. Well, perfect. And Jen, was there anything that you wanted to cover?
Yeah, so I mean, I just wanted to, I know we talked about product a lot today, but I just wanted to make you, Adam, and your agents at Back9 aware that we do have an advanced sales team too. So if you ever come into a scenario where you have like a very complex case, and you kind of don't know where to start with it, or there's a lot of tax questions and you don't know how to answer those, you can lean on us because we have a set of advanced salespeople who are attorneys, CPAs, all of that, very knowledgeable, probably the smartest guys I've ever met in my entire life. So I just wanted to let you know that that resource was out there for you guys.
Oh yeah, I guys, I cannot tell you how many times I have taken advantage of that, because we're all experts in something, but when you go back into some of these high value cases that are very complex and they have a lot of moving parts, absolutely and 100% get those folks involved. They are just as motivated as you to get that case, so it's good to bring in the big guns and form relationships with these folks, as well as with Ryan and Jen here too. Throughout my career, the most I've ever learned were from wholesalers, internals, RVPs like Ryan, Jen here as well. So definitely reach out to these guys and make friends. I do have a question. Damon, your hand's up. I'm going to unmute you here real quick. Damon, how's it going, man? Can you hear me? Oh, I think you're on mute.
There we go. Can you hear me now?
Yep,
Yeah.
loud and clear, Damon.
Okay, good. I was going to ask if you guys had some time to go over some of your, I guess, your most common riders. I am contracted with a competitor, and I used to be a career agent with New York Life. So I kind of wanted to see where MassMutual would fit in, with the carriers that I work with.
Yeah, so I can let you know the riders that we use probably the most often is our paid up additions rider, and it's called ALIR, the ALIR. It's additional life insurance rider. In simple terms, it's just our paid up additions rider. So when I'm overfunding a policy, Damon, I will put as little amount as I can towards the base, and then I'll dump everything else into the paid up additions. And what that does is it allows us to drive down the death benefit pretty low and try to maximize that cash. So that's probably the most common rider we use on most cases. And then we also have our LISR rider, which is our life insurance supplement rider, which in very easy terms is a reducing term rider. It reduces every single year because it converts a portion every year.
Oh, okay.
Like annual renewable term. Yep.
Gotcha.
Does
that answer your question?
Are those the riders you're most familiar with?
You said the riders that I'm most familiar with?
Yeah.
Yes. So with
a different name.
Yes, I'm sorry. With Guardian, it's some similar as well. And you said it's ALIR and LISR, and ALIR is just is the regular paid up additions for you guys.
Yep. Yep.
And then LISR that adds the term itself and it decreases over time, if I
Yep.
understood correctly.
Yep.
Okay.
So it's our term blend. And then over time, as the dividends and the cash value go in, it'll buy off a portion of that term and convert it. And it shows actually on the illustration. So, Damon, if you want to take it offline, we can do an illustration and then I can point you to the pages where you'll show the term reducing every single year, because every year annual renewable term converts. And then there's usually a crossover period in the illustration where you will, and that crossover period is pretty much the term has completely dropped off at that point, and then everything has become permanent coverage.
Okay, perfect. Yeah, I would definitely love that. I've been wanting to work with Mass. I'm not familiar with it. So, I don't feel comfortable writing the client with the company and I don't know the background. So that'd be very helpful.
Yeah,
Adam, if you want to provide us some emails of the attendee list, we can reach out to people individually that want to have calls.
My pleasure.
I appreciate you bringing that up. And again, that's kind of what I was alluding to earlier. You go from an IUL world, you got the chronic illness rider. What's that? It's a chronic illness rider. Terminal illness rider. What's that? It's a terminal illness rider. You have these AILers and these listers, term blend. And so that's when some people just kind of, it's complicated. It's not that complicated. Just the riders have, like I said earlier, I wish they just called it a term blend rider. So again, don't get too hung up on the riders. At the end of the day, they're not all that complicated. And if you want to get more in the weeds on them, we can certainly reach out to us. On the same token, you mentioned you do a lot of business with Guardian. Guardian's a great company. If you ever kind of want to know where we stack up against Guardian or any other company, where's their positives and where's our positives, again, that's something that our competitive unit can help. That's not necessarily trying to put anybody under the bus on that, but just if you're kind of, hey, I deal with this company a lot. I'm curious on working with you. Show me your strengths so I can kind of compare them with their strengths. We can kind of help do the homework for you and be more than happy to do that. If there's certain carriers that you're working with and you'd like to consider MassMutual.
Thank you both. Damien, that was an excellent question. Thank you. Next, we actually have a dear friend of mine and Back Nine's advanced planning director, Mr. Paul Pesci, asks, can you cover company strength, Comdex, S&P, and Weiss?
Yeah, I don't have that offhand. I have I showed the report card earlier in the presentation. We have a piece that I don't have handy to pull up real quick that I know Paul, I can send that out to you if there's value in that. And then certainly Adam, I can copy you on that. And if that's something that is important to the group, feel free to send out.
Yeah, actually, I think last time I checked, Comdex is in the 90s.
I think it is. I just don't want to shoot from the hip exactly on what it is. And
I mean, like I said, after 174 years, I would hope so, right?
Yeah, right.
It's 98 out of 100. I just
98.
pulled up the piece you were talking about, Ryan. 98 out of
There you
100
go.
with the Comdex. Yep.
Yeah. Let's put that. Let's put that on the. Like I said, let's put that on the follow up. And Paul, I can also send that to you as well.
And send it to you. Yep.
Awesome. Thanks, Paul. Next question I've got from Tad is: does MassMutual provide business valuations from the advanced sales team? Also, do estate planning attorneys tend to be partial to whole life due to the guarantees?
Do we do business? The first question is yes. We do that. I mean, there's case by case basis, but if you're working with our advanced markets team, I know they've done that for certain cases. What was the second question?
Do estate planning attorneys tend to be partial to whole life due to the guarantees?
You might be able to help answer that too, Adam.
I would say yes. Yeah, totally.
Yeah, that's a kind of a generalizing. I think it's kind of person by person, case by case, agent by agent. So we certainly see it. Yeah, we certainly see it. But for me to kind of blanket answer that, you might, like I said, you might know more than I.
So I'll add a little bit of color to that. And then I guess that really does come down to the actual estate planning attorney and how the trust is actually structured, for instance, because it may be a cost savings factor. So in which case they would look at something like a GUL, which has, basically no cash value. You may get a return of premium at some point, but it certainly is slimming it down. It's death benefit only, right? Now, an estate planning attorney may also like the fact that while whole life does provide guarantees, it does provide some liquidity to the estate as well. So if there was, say, an emergency loan needed, if we needed to take money out of the policy for some reason, that there is that cash value available. And again, that it is on a guaranteed basis, there's going to be something there. Whereas, if we don't keep our eyes on an IUL, there's a potential for a lapse. And well, we certainly don't want that in an estate planning case, especially if we're considering something that's 20, 30 years out. So hopefully that answered your question there, Ted. Okay, cool. Anybody else? Yep, going once, going twice. All right, well, I'll tell you what, let's get to our last question here. So, and I guess this one is I'm gonna lean back to you on Jen on this one because we talked about it. We get it all the time. Be your own bank, infinite banking, et cetera, et cetera. We don't call it that in the industry because infinite banking is an actual trademark term, but maybe can you shed a little bit of light on what's happening? Why do we use whole life for these type of structures and concepts, maybe versus an IUL, and how does MassMutual kind of play into that?
Yeah, so I can let you know, we are not, if you ever have an email, don't put infinite banking in the subject line or in the email. I can say that we do not support the infinite banking, but we do know the concept. The concept is that high early cash value in like year 1 and 2, and being able to pull that and pay it back. We can design it. I just can't promote it. So we know what design you're going for. We know that you want the high early cash value. Usually I'll use my whole life 10 for that product. And then I'll add another rider, Damon. Actually, it's called the renewable term rider. So it's a 10-year term that you just put onto the contract. And then after 10 years, it drops off. And really what that allows us to do, Adam, is overfund that policy to the max without being a mech, and then letting it ride out tax deferred.
Definitely. And most importantly there, avoiding the mech. Right. I think a lot of agents haven't really been brought up to speed on what that is. A MEC is a modified endowment contract. And at the end of the day, what it really kind of means is if you put too much premium in too soon and not enough death benefit, the policy will lose its tax advantages, right? Because when we go to extract the money from the cash value here, we're using loans, right? That's how we're avoiding taxes. However, if we hit that MEC, and you take money from it, now it's subject to ordinary income taxes. And, if you're talking to a client that's a high income earner, that could put them in the 40, 30, possibly 50 if they're in California total tax bracket. So definitely want to be careful of that. But thanks,
yeah.
Jen.
Yeah, I'd agree with that. It's not necessarily illegal, but it's, as Jen mentioned, it's not something that we support. I mean, and so as she mentioned, we just don't feel the real underlying value of life insurance is used in these type of sales. And so, it's if you guys ever have any questions on that, you certainly don't allude to the fact that that's what it's being used for.
And I think the theme is if it sounds too good to be true, it probably is.
Yeah, they just tend to have a higher lapse rate. It's kind of goes to the wrong customer, so to speak. It's just kind of just not in our best interest, if you will. So, but not illegal. Well, not illegal.
Mr. Paul Pesci has his hand up. Let's take one more from Paul, and then we'll wrap it up here to be respectful of everybody's time. And yes, Christine, anyone who has registered will receive a recording of this as well as any documentation that MassMutual provides here. Paul, you're actually off mute. I think you're muted on your end. Paul, can you hear me? Oh, there we go. How about now?
Thank you so much, Ab. I'm sorry to jump into your seminar here real quick, but since infinite banking came up, also known as Be Your Own Bank, also I'm super familiar with MassMutual's position on this. When I first heard the concept, I went out and bought Thompson's book, Nash's book. I read them, and let me say this. Ryan, you're 100% correct. The way the books are being written for the general public, they're selling this as an alternative to a checking account or a credit card. And let me ask anybody on here. I mean, everybody on here probably has a credit card. Seriously, your kids might have credit cards. Managing that risk, that debt risk is with a credit card is hard. Can you imagine trying to manage it with a policy? Life happens. You put in, let's say, I don't know, $20,000. You pull out $19,000. Now you're managing interest payments, and all of a sudden you miss one. Well, it's not like missing an interest payment on a credit card where, yeah, it might accrue. They may shut off your credit. You do it with a life policy, you lose the policy. Life happens. It's a bad idea. Now, I'm not going to say infinite banking. We use cash value life insurance for cash value reasons. But again, it's usually somebody like if you have a builder with a net worth who's used to dealing with interest rates and arbitrage and knowing what they have to do. I had a billionaire builder. My wife used to work for her husband. And so it was an intimate situation. And after her husband died, she's like, look, my family are idiots. All our money's in trust. And I like to play with real estate. Yeah, so we took a big chunk of change, dumped it into a policy, and yeah, she plays with real estate because it's quicker to get the money in it. But again, she has staff, she has people to look after it. That's a kosher transaction. Yes, yes, there has to be insurable interest at time of issue as required by all law regarding life insurance, things like that. But I just wanted to back Ryan up on this and say, look, not a good idea, generally speaking, to rank and file type clients. Just not a good idea. That's it.
Yeah.
Thank you for your
You're
time.
right. I think it kind of, correct me if I'm wrong, I think the trend kind of took off on TikTok, and it kind of caters to that younger customer who's got less disposable income or investment sophistication. They typically have no dependents and obviously no insurance need, which is kind of what life insurance is for.
That's
the worst part is when they need to move into a new apartment and they need a deposit first and last month's rent. Hey, let's take it from there. And then with all good intention, I'm going to repay that over time. No, you're not. Not if life happens. So that's the way. I'm just saying it's been my experience. I have 36 years experience in this industry. I know I've seen it over and over. And so haven't you, Ryan. You and I go back a little ways, if you remember.
Yeah, of course.
Of
course.
By the way, congratulations. Glad to see you over here at a great company. Really do love MassMutual. So
thanks, guys. Appreciate it.
All right, let's sneak in one last question here and we'll go ahead and wrap up. And Ryan, if you want to go back to the dividend slide and give me 1 second so I can ask the question here. Okay, so if you let's see who was really paying attention. We talked about dividends and who was paying out the highest dividends rates. So for 2025, can anyone tell us what was MassMutual's dividend rate? It was on a slide that Ryan showed a little while ago. Oh, Damon, quick, he's correct. Should we let Damon win twice? I like Damon a lot. What do you guys think? Anybody else? Well, I guess we know the answer now. So Damon times 2. Oh, here, I'll tell you what, Mr. Farmer, you came in second place there. If you will email me your shirt size and shipping info, I will be happy to accommodate and we'll get you a shirt there too as well. All right.
He's gonna have all this all these shirts. I hope he's appointed.
I know, right?
Right? Yeah, we gotta make sure he's appointed now. He's gonna be representing more than I am.
We will make that happen. Well, excellent. I don't want to take up everybody's whole day here, and I see most of you have hung out long past the hour here, so thank you very much for that. Again, I really want to thank you, Ryan, Jen, for hopping in here, for sponsoring that, and really dropping some gold and some knowledge here. And folks, if you like these, please share. Please, for those that came from the group, go into the group, hype me up a little bit, talk to your peers, get us out there. We're doing these trainings really to educate agents and make everybody better, make the industry a better place. Mr. Powell, I'll hang out here, but for everyone else, thank you so much. You will get a copy of this if you registered, as well as the slides and documents, so hang tight for that. And of course, if you need anything, you know where to find me.